And this webinar is related to our recent launch of an exciting new portfolio, a series of risk-based portfolios across the whole risk spectrum, 100% equities to 100% fixed income. It's called the Endowus Factor Portfolios, a bi-dimensional. So we use only dimensional funds to construct systematic quant factor-driven portfolios. So really excited to have two amazing guests. We have Joel Kim, who's the CEO of Asia ex-Japan and head of international fixed income at DFA. Say hi, Joel.
Good evening, everybody.
All right, fantastic. And we also have Joel Teasdel, who's the head of wealth management group for Asia ex-Japan for DFA as well.
Good evening, Sam. Good evening, ladies and gents. Great to be here.
Fantastic. So we have like an amazing presentation today. We've entitled it value versus growth, because that's the most pertinent topic that everyone's talking about. Is value back, is growth dead? And these are factors. And we want to like touch upon this and really delve deeper into who Dimensional is, why we've built this factor portfolio with Dimensional, and why we think it's the best thing since sliced bread. Okay, so disclaimers from Endowus and Dimensional. Once again, we are using Slido, guys, so please go to the Slido poll. If you are on YouTube, it's below on the link. If you want to find it later on Facebook and LinkedIn as well. Many people are joining us across different platforms. But if you leave your questions and upvote it, then we'll go to the questions that are most requested. So basically, a quick introduction on Endowus. For those that don't know us, Endowus is a fee-only digital wealth platform. We're famous for being the first and only digital advisor for CPF, but effectively, we're the only ones that marry private wealth and public pension investing in a seamless experience on a single app across all your savings, your cash savings, your CPF savings, and your SRS savings. We're backed by some amazing global strategic and venture partners, and we've been winning a lot of awards. The ones that I would really highlight is UBS, the biggest private bank in the world. Their first fintech investment in Asia Pacific is Endowus. EDBI, the global investment arm of the Economic Development Board here in Singapore, and many other wonderful investors. And we want to introduce the Endowus Factor Portfolios by Dimensional. We launched it a couple of weeks ago, and they're really excited, getting good traction and good responses from the market. We remember that we have been using Dimensional funds for a long time in our flagship portfolios. So please check out our insights article on the launch and a deep dive article for those that want to delve much deeper into it, explaining all the details of where this is positioned within our core satellite strategy, why Dimensional, and we go through a lot more detail. So today, I'm not going to bore you with all the details. I'll flick through it very quickly on the Endowus side, and I really want to spend more time to really delve into Dimensional and the way they invest. But this chart is something that is really interesting. We use it for our institutional clients as well, because they want to see where systematic factor investing, especially the way Dimensional does it so excellently, they're always asking us where that sits in. And I think, we have the two barbells, active investment strategies and the passive investment strategies. And, we see what are the, who does it, how they do it, and, what is the normal outcome. So the majority of active funds obviously underperform over a long period of time. Indexing is something that is very popular. Obviously, passive investing is great at low cost, but if it's at high cost, that's really bad. Because in the end, indexing is all about trying to, really meet the market. So 0% outperformance, 0% underperformance. But the underperformance occurs from the cost of investing by index. And so, you're going to be always index minus cost. But with systematic factor investing and the way especially Dimensional does it in a very efficient manner, you're targeting the compensated returns and really harvesting these factors in a very efficient manner. That leads to majority of the funds outperforming over a long period of time. Now, what are factors? Factors obviously explain they're the key drivers of investment returns over the long term. our dimensional advisors, Dr. Eugene Farmer, Nobel laureate, and his colleague Ken French, discovered the 3 factors and consequently the 5 factors of investing. And these empirical evidence, which is persistent, pervasive, and prevalent, and can be harvested at low cost, are really important discoveries that Dimensional has put into practice. And in equities, the Dimensional team will go into this in more detail, but the value, quality, or profitability and size factors, and then on the fixed income duration and credit quality are really important. And really, it's about, I think the difference with Dimensional with many of the other systematic factor-based investors, and there's many out there, is that a lot of guys focus just on that factor. So it's a value fund and they only own value, or there's a small cap fund and they only own small. And many of them are just exposing themselves to certain factors and not having this broad passive market exposure. So Dimensional owns the whole market, tens of thousands of stocks around the world and bonds, but they tilt the portfolio towards the proven factors of return and overweight them. And that's something that is unique, but also it, to be able to do that at such low cost is amazing. And to make that available to retail investors here in Singapore is tremendous. And that's why we partner with them. And the Endowus Factor Portfolios is, something that sits in our core portfolio range, is really low cost, globally diversified, and it's also our first discretionary portfolio. We launched 2 new funds that were previously not available here in Singapore. We seeded it and worked with the Dimensional team to launch it into Singapore in Sing dollars. So the 2 new funds are the US Core Equity and the the Emerging Markets Sustainability Core Equities Fund. And this is a diversified emerging market fund, but also has exposure to the sustainability angle. So that's fantastic. And marrying that together with the existing funds, Global Core and Pac Basin Small Companies, which is the lowest correlated fund in the equities space for Dimensional, builds a portfolio that's truly diversified and low cost. And then obviously on the fixed income side, we have all 3 funds are available here in Singapore in Sing dollars from Dimensional, and we balance that into a low cost diversified exposure in fixed income as well. So a tremendously exciting time to be investing into factors, and we're doing that with Dimensional at really low cost, so we're really excited. The final piece is the discretionary aspect of it, and I think there's some questions from our investors on what does it really mean. It actually doesn't mean too much because we approach our investments and our portfolios from a very strategic and passive asset allocation framework. We think that is the best way to manage the portfolios, and it's the higher probability of success in reaching the outcomes our investors need. So there is no active management. There's no tactical changes to the portfolio like some of the other players in the market where they move around things, sectors and countries a lot. We don't do that. So that's no different from this discretionary portfolio. The only thing that discretionary portfolios means to us is trying to make it more efficient for clients in terms of their user experience, because the way, if we have a better fund, that is, or the same fund that is a lower cost or Sing dollar denominated, or it's more efficient, or is a better risk-adjusted return portfolio, then we would tweak it or improve it. So it should be seen almost like a rebalancing rather than a tactical or active change in the portfolio. And the efficiency exists in the process and the speed in which we can do that. We'll maintain the high level of transparency that Endowus is proud of, giving you well advanced in time all the detailed information that you need with regards to what changes will be made, how we'll do it, what are the percentages of the weights that will change, and we'll always rebalance it back to the strategic asset allocation that is best for our investors. And really excited because this is part of a series of events we've done with Dimensional over the years, in the 4 years that we've been in existence. And both our speakers today, both named Joel, with different surnames, JK and JT, I call them, have been on the platform with us, and also with Greg. We've also had other great speakers that have been on the platform talking about various topics. But I thought it would be good today to just revisit some of the core tenets of who Dimensional is and introduce to a much broader audience, because Endowus has obviously grown and many more investors have come on the platform who have maybe not had exposure to Dimensional. And with the launch of the Factors portfolio, I think it's a great time to really go into a bit more detail for those especially who are into this type of stuff. So with that, I'm going to hand over to Joel Kim and the Dimensional team. Over to you, Joel.
Thank you very much, Sam. And again, thanks for having us over, even if that's virtual. So yeah, let's actually start with introducing like Dimensional. I mean, obviously, you, Sam, mentioned a couple of things already. I realized that we're in Asia, not yet a household name. So let's just come with a couple of like facts around Dimensional. We've been around for a long time, actually. So David Booth founded the firm over 40 years ago. And at this stage, we're actually managing this as of the end of last year, close to $680 billion, so around 900 billion Sing dollars in terms of like assets under management. Over 1,400 employees spread out over 13 offices. 2 of those are actually here in Asia, Japan. So the regional head office is in Singapore, and then we've got a smaller office in Hong Kong. I think what makes Dimensional unique is that we've come to like that asset base and like the growth. Growing the firm organically. Secondly, being very consistent when we talk about investment philosophy, how we invest, and what we essentially promise our clients as in like what we expect to deliver to them across various asset classes, whether it's equity or fixed income, we're going to talk about tonight. So if we then move on, so Sam, you already mentioned like evidence-based, I saw in your slides, and based on like academic research. And if I can provide a brief history of like, yeah, how did this all come about? So in the 70s, David Booth, the founder of the firm, actually studied under Professor Fama. He was working on his PhD, and at one point realized like, my future is not going to be in academia. So he actually ended up starting Dimensional in 1981. And the whole idea that he had with founding Dimensional was to, one, identify needs of investors that we could be met in a rigorous scientific way, essentially applying academic research to practical investing. And so that started with a US microcap solution in 1981, but that quickly branched out to fixed income in 1983, global fixed income in the early 90s, adding value strategies in the early 90s, and then multi-factor solutions in the 2000s. Lots of stuff in between, but also pretty quickly in that process, in his conversations with academics, he basically he approached Myra Scholes, Merton Miller, Gene Fama, who was now a Nobel laureate, and asked them at that point already if they wanted to join Dimensional. And so even now, with people like Kenneth French, Robert Merton, another Nobel laureate, and Robert Novi Marx, joining at a later stage, you will find these academics, supporting our business in various positions. Participating in investment research committees, serving as resident scientists, consultants, being a director in various bodies like the fund board in the US, for example. And so it's still very much like the core of like what we do is underpinned by the rigor in academic research and basically the contributions of like the people that you find on the slide. Now, Sam, if we move on, you already had a couple of things that describe basically answers to the question like what exactly is factor investing, and yeah, you can contrast that to like other investment approaches that you already mentioned, like pure passive or active investing, where you essentially try to like outguess the markets and make directional bets. I don't want to spend too much time on that right now, and just like focus a bit more on the question: what exactly is factor investing then? So there's different ways to define that. So one definition is that you're still seeking to outperform the market, but you do this through a rules-based approach by structuring an investment portfolio around factors, linked to differences in expected returns. So you can think of it more on a practical basis, on a daily basis. One, you obviously have to identify what exactly are these factors, then what is supposed to work. And you apply that on a day-to-day basis by rank ordering the universe on, for example, profitability, on relative valuation, and on the size of a company. And over time, by rank ordering the universe on those factors, and for example, tilting those portfolios to those factors, you obviously hope to earn premiums associated with those factors. That's driving the alpha in the portfolios rather than making statements as we expect something, like a particular market to perform better, and like looking into the future from that perspective. Okay. So from that perspective, if I can link it back to what exactly are these other two alternatives than index and a traditional active? We feel that it's sort of like combining the best of both worlds. What we do, you share the benefits of like active. We definitely seek outperformance, but without outguessing the markets, without forecasting. But we do that again, to your point, with a cost basis that is much more akin to passive, and in some cases even better in our view. To your point, thanks to the way we implement. Okay, and that obviously should benefit investors that invest in our strategies. Now, there were a couple of other things before I hand it over, and we go to what exactly do we do in terms of serving clients, and my colleague Joel Teasdel will flesh out in more detail what does it do with what we do in the equity space. But just a couple of additional comments to what you already had in your slides. Clearly about factors, you got to pick the right ones, the ones that work. You had a couple of things in there. They need to be persistent, pervasive. But I would add a couple of things there. There needs to be an underlying logic as in why the factor should work. Can you explain it? Otherwise, what you do is essentially looking for patterns in data, and you end up data mining is the right term. And another important thing, and this is definitely very important for any systematic or factor approach, especially now with a lot more focus, everybody is publishing papers on it. You mentioned, well, we use a couple of factors. The flip side of that is that in many papers, like what some of our competitors now have found out, is that there are hundreds of factors. So the truth is obviously somewhere in the middle. And by being very rigorous in your research, you obviously want to make sure that whatever you focus on is, one, properly researched, but it's also tested whether it actually is implementable. Can you actually implement these strategies at a normal cost, that net of costs? They obviously still deliver a good investment return, a good investment experience to clients investing in your strategies. So with that, I think making a good claim in a research paper and being able to implement that, again, we've done this for 4 decades, where over 40 years, we've proven that we can actually make it a reality in actual portfolios. All right. That ends my part. I'm going to hand it over to Joel Teasdel that will make a couple of additional comments, and we'll move over to equities.
Thank you. Thanks, Joel, Kim, Sam. Just before I move on, any questions thus far on things you'd like us to clarify or thoughts you might have?
No, I think we can jump in with some questions as we go delve a little bit deeper in the equities. But I think one comment is that obviously, the practical aspect I thought was really important, right? I mean, there's a lot of factors out there, hundreds or whatever other people tout, but some of it might, over 15 years lead to a 10 beeps outperformance. But if the cost of implementing that is higher, then there's no point in exposing yourself to that factor. So it has to be practical. And I guess, the systematic aspect is really, really important, right? It can't be just willy-nilly, I feel like this time, and then I'm going to work on this factor next. It has to be a systematic process that makes sense and is, implementable over the long term, right?
Absolutely.
Yeah, I totally agree. So what needs to be very clear, and you already had it, it's not a black box, but it's also not just discretionary on a discretionary basis, turning things on and off. And so if you're selective in the things that you do, may not work every day. We don't want to have to change your investment process every month because something doesn't work for that particular week.
Yeah. And Joel, JT, you're going to talk about advice. And so basically, it's not a robo advisor. It's not a robot or an algorithm or a black box. It's actually a very transparent process, right?
Well, absolutely. And the thing about, what we do is it's no good to anybody unless you have a disciplined planning structure around it, whether you're a sovereign wealth client or you're a large institution, or whether you're a wealth management client of Endowus, you've got to have the discipline to stick with the strategy. Otherwise, you can't say Dimensional's better than anybody else. And you got to know how to drive the car before you get the keys to the Ferrari. You put a bigger engine in something that's not a Ferrari. So I like the observation you made, Sam, around and Joel, and implementation. David Booth says, what does Dimensional do? Is that we implement the great ideas in finance. Lots of research being done, but we're expert engineers in implementing to make sure we can, get the return of the market, plus a bit more if that's what clients want us to do. And so I'll talk a bit more about that later. But I think, we've had a wonderful relationship with Endowus. It's great to see the role you're playing in Singapore for the end investor. And this is the other thing that Dimensional is passionate about and has been for probably 30 of those 40 years that Joel Kim mentioned, is we've been working with independent or fiduciary-based wealth managers around the world for over 3 decades, because we realize how important the planning aspect is and the discipline is for the end investor getting a good result. Now, one of the reasons why, as Joel Kim said, we are not a household name yet is that we never paid anyone to sell our products. We care a lot that investment should be bought, not sold. You care a lot about that. That's why you've got such a great business, because you're shining a light on a lot of, let's call it suboptimal practice that exists in our industry around the world. And Dimensional cares a lot about that. The wealth management business was founded by an ex-fee-based advisor who left Wall Street, decided that he needed a different set of tools to help solve problems for his clients in a strategic way, and he just couldn't find a solution. So the reason why we are proud to work closely with Endowus and the other small number of fiduciary-based advisors in Singapore is that you work for your client. Your client pays you for the asset allocation, for the structuring, for selecting the managers, and there's zero conflict of interest in you wanting to put the best solution on the table for your client. That's not always the case, unfortunately. And so,
absolutely, Joel. Can I just jump in and just
please
reiterate that by saying that, it's unfortunate, but Dimensional is, as far as the only company that refuses to pay distribution fees, trailer fees or retrocession fees or kickbacks or commissions, or there's so many names for this thing because they're trying to hide it or rebrand it so that they can, loaded fees, whatever you want to call it. But, I'm really proud and, I love working with Dimensional precisely because you focus on the product, the fund, the quality, the execution, delivering returns that clients deserve, and delivering it at such low cost that the chances of success is so much higher. And, you're the only guys who are doing that. So I really applaud you. And we're very proud to be partnering with you here in Singapore to, proliferate what is best practices, global best practices that more companies in Singapore should be adopting. Yeah.
Sam, thank you. It's the reason I work for Dimensional, same as Joel Kim and everyone else. And the fees are important. And the reason why is because we're in it for the end investor as well. We know to have a successful business, you've got to be able to systematically over the long term deliver a return that's more than just what you can get from buying a beta instrument. And fortunately, we were doing this before beta instruments really existed because we helped create them. I'll come back to that a little later. But the point I wanted to make from this slide is the vast majority of wealth management practitioners in Asia, not just Singapore, have a sales-centric model where you have a product provider whose proposition is, I can outguess the market. For that, I'm going to charge you a large fee because I've got great alpha ideas, and I'm going to get salespeople to sell that to end investors, and I'm going to pay the salesperson. What happens then is that sometimes that leads to suboptimal conclusions because people are always looking for the next best transactional sales idea to sell to an end investor. That's not your business. It's great to see your business is that sales-centric model. And this is what's so fundamental about the nexus between the investment philosophy and the advice behavior. When it's a fiduciary-based model, as Endowus is, client sits at the top. You're working for your client. And when you do that, you scour the earth for the best investment solutions you can find, which is not about making a forecast. And it's not about paying someone a commission to sell the next best idea, because it results in suboptimal performance. It's not good for the end investor at the end of the day. Okay. Now, I'll explain why in a minute that links to Dimensional's investment philosophy of trusting markets and looking for the highest probability way of improving the performance of your equity and fixed income portfolios, because that's our raison d'etre. All right, let's go to the next slide, please. So to give the audience a bit more context of our capability in this area, of the roughly, let's call it 700 billion or so thereabouts Dimensional manages, more than half of that comes from individual families and end investors working through fiduciary-based advisors like Endowus. Now, this is new to Asia. Singapore is leading the way. You guys are, one of the handful of firms leading this charge to get better outcomes for investors, but it's not new in many other parts of the world. I've spent 25 years in this industry in the Pacific, in Europe, and in Asia, helping specifically people transition from that commission-based model where it's speculative, trying to outguess the market, to working for my client. I want to get more strategic, lower cost, better outcomes. And so there's probably, I'm going to say, somewhere between 5,000 to 10,000 firms that we're working with globally, in Europe, in the rest of the Pacific, in North America, and so throughout Asia now, who are trying to do that. So if you're an Endowus investor, good, you're an early adopter, you're learning from the best that's out there in terms of helping put the odds in your favor to be successful. And that's across a range of asset classes. So I just thought that would be some helpful context. And that's, you don't see us on advertising because, we want to keep costs low. We don't really need to. We just try and support at the back end. All right, let's go to the next. Sorry, Sam, did you have a comment to make?
No, wonderful. So we're going to jump into the equity piece.
Jump into equities. So I know we're about halfway through time here. Joel Kim talked about the philosophy of the firm, the one philosophy. It's always been about how do you put your odds in your favor of doing the best by investing into capital markets, whether it's equity or fixed income or other. That's what the academic contribution analysis has always been about. That started with, as Joel Kim said, when David Booth was an assistant teaching professor at Gene Farmer, what philosophy should I take to help put those odds in my favor? Back then, right, the groundbreaking research that was coming out of the academic community from Farmer and others was trust the market. Don't try and outguess the market. There's millions of participants in capital markets every day putting ideas into prices, buying and selling. Somewhere in between the demand for the buy and sell, you arrive at an equilibrium price for every security. Whether it's right or wrong, it doesn't matter. The price is the price. That aggregates up into an asset class. Conventional wisdom at the time, and still prevalent today, was if I'm really smart, if I work hard, if I have better resources, I can find out where the mispricings are. I add value by spotting the right or wrong price. There is decades worth of evidence now, as Joel Kim pointed to, that traditional way of doing things is flawed because you need more information about the market all the time in order to have better ideas to spot mispricings. And so Dimensional from Darwin said, we're not going to do that. We want to trust the market, get market returns, and look for higher probability ways of getting better return than the market systematically and outguessing it. And that led to the revolution of factor-based investing, which Joel Kim talked about. Dimensional started as a small cap manager, and value, profitability, and other things. So what we're aiming to do is systematically outperform by identifying large groups of securities that have similar characteristics, that have had historic differences in return that are matched with theory that supports that. Okay, so within the equity portfolios for Endowus, 3 key things that we focus on. One, in addition to the market, overweighting smaller companies rather than larger companies. This is called the size factor. And it's a premium. What that represents, if from an academic perspective, is what has the return of large companies been? What's the return of small company been? And that difference is the premium, the small cap premium. Okay, so that's like if I've gone by all the small cap companies at really low cost, I would have got a higher return, and I should get a higher return because it's a discount rate effect and it's explained by valuation theory. I'll come back to that in a minute. The second one, relative price, is the same thing. You know, if I take 2 companies that are roughly have the same market capitalization, the one with a lower relative price has some kind of inherent risk in there. It's been discounted relative to its peers, should owe me a higher return. Okay, just like a small cap company is, you've got 2 companies with the same amount of shares outstanding. The one with a lower price, there is some inherent risk there reflected in price. It should owe you a higher return. Profitability is the same. Okay, if you take 2 companies that have the same market capitalization and the same relative price, due to its forward-looking cash flows, it must have a higher discount rate in order to be more profitable. Sounds a bit like a strange concept. Let's go to the next slide and let me explain this for you. This is super, super important. So thinking about this from an academic perspective, they look at it and say, what is investing? It's buying an asset. It's what you pay and what you get. If you can get something cheaper, you know, ceteris paribus, if the cash flows, expected cash flows are the same, why wouldn't you do that? Systematically. And that's the small cap and the value part of the equation. They sit on the left-hand side of the equation. They're dimensions of price, size, and value. When you think about expected future cash flows, profitability of a company is very, very important. So again, you take the example of having 2 companies that have the same relative price and same market cap. The one with higher cash flows has got to have a higher discount rate in order for the price to be similar. So you should expect a higher return from more profitable companies. These are the 3 key concepts that we look for in order to determine what goes in the portfolios. As Joel said, there are hundreds of different factors that people have looked at. These 3 main ones, in addition to the market premium, size, value, and profitability, subsume and explain most of the rest. It explains 95% odd of the variance in return. So as an investor, if I want to get the market return plus a bit more, why would I not structure my portfolio such that I'm exposed to companies that are a little smaller in market capitalization, a little cheaper, and with higher profitability as the best way of trying to improve my performance? Sam, I'll pause there in case there's thoughts, comments, or questions.
No, that's fantastic. And I think it's really helpful. But obviously, I think in the end, a lot of investors are, is this really true that you guys can actually generate better returns? You know, show us proof. The proof is in the eating of the pudding. So would love to see a little bit more details on the performance numbers and what the numbers actually say. You know, let's go and look at the data. Yeah.
Does this theory pan out? Has it panned out in different markets? So maybe let's go to the next slide. So the next slide should be just coming up now. All right, a lot of numbers on this slide. Let me try and keep it really simple for you. These are not dimensional funds. This is proof of the pudding in the historical returns of these factors. So if I just look at the left-hand side of the page, I've got 3 rows. I've got profitability down the bottom. I've got relative price or value in the middle, and I've got size at the top. And then vertically going down the page, we've got 3 columns: US stocks, developed markets, ex-US, which includes Singapore, and then emerging market stocks. What you're looking at here is 44 plus markets around the world: US, developed ex-US, and emerging markets, and the historic premium that has existed for small over large, value over growth, and high profit over low profit. So if you start in the US, which is the biggest set of data that you have, and this is what Gene Farmer and others started looking at back in the 60s, right? Originally, then once they got the market premium, market beating treasury bills, they said, what else systematically is related to this theory, that's what they find. So you see small caps in the US beating large caps by around about 2% annually for, close to 100 years. That's a long time, okay? Then value beating growth, so the relative price, low relative price, 2.6 versus 9, again, 2+%. And then profitability, similar kind of magnitude, okay? The same relationship you will see, I won't go through the numbers, but it's the same in the developed and even emerging markets, okay? This is what one would expect if markets price risk well, and you should be rewarded, for taking on the additional risk of investing in securities with higher discount rates. One of the founders of Dimensional, Merton Miller, is famous for, those Nobel Prize for talking about the cost of capital of organizations. And one of the things that came out of that is like the discount rate is the expected return of the investor. So the higher the discount rate, the higher your expected return. Why? There's risk involved there. The way you ameliorate that risk is not to try and find the best small value or profitable company, is to buy all of them in a systematic way as cheaply as you can. So you take away the idiosyncratic risk. All right. So then what risks are you left with? You're left with the strategy risk that should persist into the future, that size, value, and profitability should persist in the future. And look, they have. You can see over the long term here, you've been rewarded. What is one thing we don't know how to do, because we think it's unknowable, is know how to always jump in between the factors, or in between the countries, or in between the sectors, to know when they're going to rotate. Why? It's a risk factor. If we knew how to do that, there wouldn't be a premium, right? And this is why you play such an important role in doing that strategic allocation to the different factors and geographically diversified to maintain the discipline, because individually, one of these dimensions generally is not showing up. Right? It's very rare they all show up at the same time, but when you diversify across all of them and globally, you vastly improve the probability of getting a better long-term outcome. But you need to stay invested in those securities all the time, because the securities are moving around from large to small, value to growth, high profit to low profit, based on information that goes into the market every day, based on people's forward-looking expectations of the future earnings of those companies. So it's an incredibly active portfolio. You're getting exposure every day as price change. It's just no forecast, right? Which is the traditional, synonym of, forecast equals active. Well, in our view, active is making sure you're true to the philosophy. You continue to execute to be exposed to those higher expected return securities as price changes. And all you're relying on by putting your odds in the favor is that relationship between discount rate and expected return holds. And the market, on average, does a pretty good job of synthesizing the information that exists all over the planet into prices that are fair. I'll pause there.
Yeah, fantastic. And, these numbers are very solid. This is the science behind it, right? It's not just, harvesting like pockets of different years and different periods, but this is long periods of actual data that we use. But obviously, I mean, it's not going to be like, just as we say, investing in the markets gives you long-term returns. It's not going to be every single year that these factors outperform.
That's right.
And yeah. So I think, we have to have that right perspective. Would love to get a, better understanding of, when do these factors maybe show up, or,
Sure.
Does it have extended periods of underperformance and, stuff like that. I think the time element is something that a lot of investors always are curious about.
Time is really important. And I'll jump to the next slide in just a minute. But before we go there,
before we do,
give away the answers too quick, Sam. Remember, this is representing decades worth of rigorous scrutiny by academics thinking about where returns should come from, and then empirically proving it beyond doubt, statistically significant to back it up. The thing about it is that if you could take risk completely off the table, when you had to time the equity premium and you had to time the different factors, there would be no risk. That'd be the new risk-free rate, away you go. There's no additional risk, no premium. We have looked at this stuff in huge amounts of detail, both internally and externally. We have more than 100 people in our research team internally, plus armies of academics that are affiliates to us. And the unfortunate thing is no one knows how to time the equity premium. It's just too much noise. There's an average return. There's a lot of variance around that. It's the same with these dimensions, small value and profitability. So if we had that answer, that would be great, but it doesn't exist because it's unknowable. The good news is the probability, we think the probability of it continuing is high because of the theoretical aspect. And, historically, the numbers support that. So we go to the next page, Sam, and I will pause after about 2 or 3 minutes. I'm going to hand over to Joel Kim to talk about fixed income because it works the same way. But if you go to the next slide, what you're looking at here is, for the US market in the top left-hand corner, close to 100 years of, rolling 12-month returns. If you get a 10-year number, on average, not on average, 86% of the time, equities have beaten T-bills. Rolling 12-month periods. That's the equity premium, which we don't know how to time. Our submission is if you have the longevity to invest in equities, we think it makes sense to diversify further and to overweight small value and profitability because the persistency of them historically has been very high as well. So you look at the 10-year periods of small betting large, it's 70+%, value versus growth, 80+%, high profit versus low profit, 90+% over 10 years. You put those all together in a diversified, systematic quarter way, you increase the likelihood of outperforming the broad market. And remember, the broad market doesn't come for free. It's low cost, but even if you buy just a beta-based index instrument, there's cost for that, there's cost for custody, there's cost for execution. So we think if you have the longevity to be an equity investor, makes sense to invest in all three of these dimensions in addition to the market to improve your probability. If you go to the next page, you'll see the patterns are the same. This is the rest of the developed world. Close to 80, 90% of the time that this is paid off, and emerging markets, it's similar. So the theory is persistent. What is great about people working with Endowus when you have a discretionary portfolio is you will maintain that strategic exposure to the allocations to give investors the best chance of harvesting those premiums when they arrive. So the probability of outperforming the market, we think, higher than anything else we know about. It's been backed up historically. And now let's just consider what the alternative is, right? So if we go to the last slide here before I hand over to Joel Kim. Emerging markets, very, very similar returns. Okay, probability is high, and the historic data would support that. So we'll just go to the next slide, Joel, because I'm just short on time here. If you look, but in the last 3 slides, I showed you the persistency with which, size, value, and profitability had beaten, large caps, growth, and low profit companies, pretty high, 70, 80, 90% of the time over rolling 10-year periods. This is what we keep bringing it back to. This is the puzzle for the investor. If you want to walk away from a factors-based approach, which theoretically should give you higher return, you got a strategic asset allocation implemented by Endowus and dimensional trading the securities every day to give the exposure there. The alternative of trying to outperform the market historically and empirically has been a lot less. Take a look at these returns. This is from US domiciled mutual funds, but it's all different types of strategies all around the world. Over this sort of 20-year period, arguably could be someone's, a long-term investor's time horizon, around about 3,000 funds at the start. About 40% of those survived, and only less than 20% outperformed the market. 20%. 20% outperformance, or 70, 80, 90% outperformance if you do it around a factors-based approach. Fixed income, story's even worse. Okay, so as an end investor, I can just take a beta product, I'll get the return of the market minus those costs. Or I can take the approach of traditional active, which is outguessing the market, which sector, which country, which stock, rotate the factors, hadn't worked out too well, or put the odds in my favor of taking a strategic approach to factor-based investing, we think, that should continue to work pretty well. I'll pause there, Sam, and see if you've got any comments before we hand over to Joel Kim to talk about fixed income.
Yeah, I think at this point, actually, we do have a lot of questions coming in, and one is something that is continuing to be repeated, and we had those slides where we broke out, the developed markets, and then we broke out the emerging markets, and obviously emerging markets, because of the Ukraine situation and Russia is being heavily affected. So there's a lot of questions about that, and especially emerging markets and why we have exposure. Do we really need exposure? Does it actually help with diversification? There's EM is more erratic, lowest performance consistently, so dragging down the portfolio, et cetera, et cetera, et cetera. There's like a ton of questions, obviously very topical. So, maybe you can, either of you can touch upon, especially for equities, I guess, or maybe Joel is, what is there when it comes to factor investing, do we need to be diversified across these geographies? What does it actually help to achieve? Maybe just a little bit on that would be helpful.
Well, let me give 60 seconds and then Joel Kim can talk about things that are happening more currently. Yes, it does. Within equities, diversification is your buddy. If you want to increase the reliability, the reliability of outcome and improve your odds of having more success, you want to own as many securities as you can across all countries, whether they're emerging markets or whether they're developed world. For any investor, investing in emerging markets is riskier. It also has had higher expected returns. Okay, because again, for geopolitical risks, like we're seeing now, they have actually given higher returns. When we do it, we don't get over concentrated on any particular country. We're highly, highly diversified. The exposures we have, and Joel can talk about this, are very, very small to markets like Russia, etc. It's really important to be diversified across a lot of securities and a lot of countries, but they are more volatile. Absolutely correct. Should someone have them individually? That's a preference. I think it makes sense for any investor from a strategic point of view. And me personally, I want to own them because I want to be more diversified. From a factors point of view, we see the same relationships in size, value, and profitability as we do in emerging markets. The slides are up there. If you go back, the persistency is there, like we see in the developed world. So from our perspective, it makes sense. It's a personal choice on how people want to invest. If you're doing it on a discretionary basis, from a diversification point of view, yes. And we don't know how to time when that's going to be better or worse either. So be strategic.
Fantastic. Okay, before I hand over to Joel Kim, I do want to say that, I think there's a lot of questions about emerging markets and why Endowus has built it this way, and why, for example, some people have even questioned why we have a separate US portfolio. I think the person was suggesting that it's actually more kind of large cap and biased, but actually the US equity fund from Dimensional is a broadly diversified US equity fund. It's a core portfolio, so it's not focused on mega caps or higher PE, and it does expose itself to all the factors within the US equity market. So the only thing is that it does have a US exposure only, and we've built the portfolio to be globally diversified and not have major geographic overweight or underweights. Obviously, the world equity portfolio or certain portfolios in the developed, the global core, for example, is maybe a little bit more underweight, US, but that's a result of the bottom-up kind of, factor tilting that exists that Dimensional does. And so by utilizing these portfolios, we've actually narrowed that underweight slightly, but really maintained the key of what the core of what Dimensional is about, which is really the systematic exposures to the the proven factors of returns, which is persistent across all our portfolios. So I'd like to just emphasize that. And then with that, I'll hand over to Joel with the fixed income stuff, the more sophisticated stuff, as we call it.
I'll keep it short. I know it's almost dinner time and people have had a lot to absorb already. Let me say a few things, and then maybe rather than getting really deep into the weeds, just like use a couple of examples so people at least get some sense of given the market environment right now, like what is it that we do? So let me start with the foundational concept here. So to Joel Teasdel's point, there's a lot that we have in common. That's the one philosophy that applies to everything. There's a lot that we have in common with equities. Again, disciplined, rules-based, should be transparent, clearly based on academic research. A lot of it is still based on like findings from Professor Fama that go back to like the early 70s, and it still works. And so again, it doesn't rely on forecasting or outguessing markets. It all finds place again in very well diversified portfolios. And Sam, I think that is a characteristic for any successful factor or systematic approach. It's not about picking, the individual stocks. It's getting exposures to exactly to your point, like the factors and the premiums that are associated with it. And that tends to be very issuer or stock unaware, right? And so that's important for people to know. And it also helps to protect you in cases where you have all these idiosyncratic risks popping up and things that people couldn't have reasonably anticipated beforehand. Okay. So what is applicable across the full range of things that we do is that we always say, well, we use information contained in market price. Now, what exactly does that mean? Listen, for fixed income specifically, we know that returns vary across, say, the duration, maturity spectrum, along credit quality, and say along currency of issuance. And so what you'll very quickly find in data is that generally bonds with longer duration or longer maturities, like riskier bonds, will give you higher returns. More risky bonds, like lower credit quality, will give you higher returns, like the credit premiums. But yeah, that's not the only thing that that's not enough. Because if I would tell you, Sam, like, yeah, you've got a client and all the exciting stuff should happen in the equity space, like what do people generally buy fixed income for? For instance, to balance out risk, to provide some liquidity in the portfolio, perhaps to bring some diversification, multi-purpose, or deliver income. And if I would tell you, well, the bonds with the highest premiums, the highest factor returns are going to be 30-year bonds, single C and Chinese property, then a lot of people would say, well, that doesn't really meet my requirements. So there needs to be something else that you do other than just identifying, that the premiums exist. So what is it that you need to do then? Now, let me start with the quick example that Joel Teasdel was showing. How do you value any asset? And so the valuation equation. It's the expected cash flows that you receive, and you discount them at a particular discount factor, right? And that's your price. Now, what is the difference between fixed income and equities in this instance? For bonds, unless you don't get your money back in a company defaults, you know what these cash flows are. It's going to be the coupons and the principal that you expect to get back at the end of the bond's life. And clearly, the discount factor in this case is something that people should be familiar with. It's the yield on that bond. So that's your price. Now, what is the difference between equities and fixed income? For equities, you have to guess what exactly are these cash flows going to be in the future. So a lot more noise around that process. And as a result, there's a lot less certainty about when exactly do you expect to get these equity related premiums in your portfolio. And hence, if I can sort of simplify the message a little bit in the equity space, very well diversified portfolios, make sure that you don't own everything by the time that these premiums show up, you're going to capture them. You don't know when exactly that will happen. Now, the nuance for fixed income is that because there's more certainty around when you get these cash flows, there's a bit more certainty on when it's likely that you're going to earn these term and credit premiums, right? And so you will see when you look at a fund fact sheet, for example, in a portfolio or the full holdings in a balanced portfolio, that we actually take active duration positions. So we vary the credit quality in a portfolio when we think it's more likely that you're going to earn these premiums. Now, and that's where I want to finish it. I will close to 7 o'clock. Let's actually use a couple of examples, right? Let's move to the next slide. And so this is something, first of all, hopefully everybody knows what a yield curve is. So I use this as an illustration. For people who don't know, a yield curve is basically a set of yields for bonds with Same credit quality, say Singapore government securities, but for different maturities. Now, if we start on the left-hand side, what you in a lot of cases see is that the yield curve tends to be upward sloping. So bonds with longer maturities typically tend to have higher yields, but that's not always the case. And we also know that it's not static. I mean, that can vary over time. Now, with all the news that you have nowadays, there's lots of noise. Inflation high, monetary policy, central banks that are expected to like start hiking policy rates very soon, like the US, for instance. On top of that, now we've got a lot of uncertainties with geopolitical issues in Russia and Ukraine. So what is it that we've recently seen? Yield curves that look a lot more like time period 2, the one in the middle. This is what, when you read the newspaper, the flattening of yield curves. Because the short-term yields start reflecting the fact that the Fed funds may have to go up. But there's a lot of uncertainty as on like, what happens with growth further down the road and inflation much further down the road. Maybe policy rates will have to like be cut in 2-3 years time. And so that makes it very difficult to, again, guess where the market is going. But what we can observe every day is that shape of the yield curve. People are even talking about like maybe inverted yield curves right now. When you look at time period 3, that is getting much closer to like, doom scenarios where growth is going to be very low. Now, we don't make any statements about what will happen tomorrow or like, say, 1 or 3 months from now. But when we look at stuff that we can observe right now, we can make statements on the back of the research that is done, that when yield curves are very flat, what we see right now, it's much less likely that you're going to earn a term premium by owning longer maturity bonds today. And hence the implication for portfolios is like, why own riskier bonds in your portfolio with more interest rate risk if it's unlikely that you're going to get rewarded for it? So we'll roll back the duration in a portfolio. We'll do the opposite where you're in an environment where it looks a little bit more like time period 1. More likely that you're going to earn a term premium. Why not buy longer maturity bonds? So this is a bit of simplification of like concepts around like, how do you in a dynamic way target term premiums? The actual process is a bit more complex than this, but hopefully you get some senses on like, what can you expect in different market environments? Now let's move on to like a second aspect of investing in fixed income, credit. We all know it's not only the Singapore government that issues bonds. We can buy bonds of any level of credit risk. And if there's something that has been very topical is Chinese property bonds, which are very risky and nobody knows exactly what the outcome is going to be there. But clearly, credit risk can be material. But obviously, you're going to get rewarded for taking on credit risk in the form of a credit premium. If it wasn't a credit premium, everybody would buy government bonds if you don't get rewarded for taking on that additional risk, right? Now, so how does this work? We also know that credit spreads vary over time. This is a period where over the last couple of weeks, with the equity market volatility and the events that I just mentioned, credit spreads have been widening quite significantly from very tight levels. Now, again, do we make forecasts about like whether it's going to go wider or narrower? No, but we can observe, and we know that in periods where credit spreads are a bit wider today, it's more likely that you're going to earn a positive credit premium tomorrow. Now, why is this the case? So why is this so special? So if credit spreads are wider, we say, well, we'll buy a little bit more credit risk because we feel you're going to get rewarded for that. And people say, well, how does that work? Because there's also actual risks are going to be higher at today. And so this is a case of like balancing higher expected returns like these credit premiums, because we know that in periods with more uncertainty, investors demand an extra expected return on top of the higher risk. Those are the premiums that we try to capture. So capture the higher expected returns while managing the risks at the firm-specific level in a systematic way. Now, listen, I just wanted to leave it here. I hope I addressed a couple of things that people typically associate with fixed income, credit. How do you manage duration risk? How do you do that in a dynamic way without basically outguessing the market? If there are any questions, happy to answer.
Yep. Wonderful, Joel. That's fantastic. Really, really helpful. But I did think that maybe we could use the last slide and, whether, the diversification benefits
Yeah.
exist in fixed income, and, the global exposure.
Absolutely. So we can move on to that one.
Just to wrap up.
Yeah, absolutely. So the diversification aspects obviously also work through as on like, why invest in only one market? So I'm not saying that you should invest in like literally everything, including every emerging market, but clearly there's supposed to be a case where by spreading out your investments over different markets, the simple example here is that we know fundamentally that not every country will have the same growth patterns or like central banks doing exactly the same thing at the same time, or other fundamental developments being exactly the same. So that is reflected in the fact that these yield curves that I was talking about will typically have different shapes. And when you look across the global set of like opportunities there, and it can help you figure out like, where is it likely that you're going to find these higher expected returns, these higher term and credit premiums, and basically tilt your portfolio towards those markets that have these higher expected returns, tilt away from markets that will likely give you lower or even lower expected returns. Okay.
Fantastic. That's a good wrap up, guys. And just a few questions that obviously has come up. One is the first one, obviously topical again, Russia and Belarus exposure. You make a quick,
So let's start with again the points that Joel Teasdel already made. Highly diversified, and again, even when you don't make statements or forecasters, and we believe what will happen with Russia. In your investment process, there's clearly a lot of checks and balances that we need to go through. What is the liquidity in a particular market? Is a market still investable? Do we see risk, even if we don't make a call on like which direction it will go? But is there a risk that things will get worse? And so we already took the standpoint in as early as 2014, Sam, when you had the annexation of Crimea. As on like this is a fundamentally different situation right now, and so across all the portfolios where you had Russia as a benchmark constituent, we went to a position where we halved the exposure relative to the index. We never went up from there. And the other thing that we've done is like what you find across all the portfolios, no access to Russia via the onshore market. Everything is happening through DRs. And so there's been a whole process over the last couple of days, and exactly again around like all the news and the noise around like the sanctions. Well, we go through it in a very methodological way. And at one point you have to like make a conclusion as on like, is the market investable? Yes or no? By the time you say it's a no, that doesn't mean that there's going to be a fire sale. There's still going to be a very considerate way of like looking at like how would you work yourself out of the positions. But again, the important thing is that even before everything started, the exposure to Russia was really small. The highest exposure, I think JT would know the exact data. I think must have been
even in emerging markets portfolios, which is a very small percentage of the overall allocation. There were less than 2% invested in Russia in emerging markets portfolios. So if you aggregate that up to your overall 10,000 securities, is like maybe a couple of basis points.
Yeah, it's really very nothing. 0.1. Maybe.
So that's very tightly managed.
Okay, guys, just moving on, factors, it's great to look at long-term numbers, and we've looked at why time is important. But I think some people are asking about recent performance, and
yes,
it's great to talk about recent performance right now. So why don't we share with the audience, what the recent performance has been, and, whether we need to hold for for decades.
Well, if you have performance numbers that you are quite rightly licensed to share with your clients about retail investment funds, by all means do so. What I would just share one thing: recent performance relative to benchmarks, conventional benchmarks, whether it's emerging markets or US or international, has been good because you've had a value premium, profitability has been strong, and size has been there or thereabouts over the last couple of years. That's just what recent performance is. I saw a question somewhere, how do we go between 2020 and 2022? We did well. but that's irrelevant. The point of it is every single day, theoretically, I expect higher returns from small stocks over large, value over growth, and high profit or low profit. And every day I expect a premium for equities over holding cash. Every day, every second I'm expecting that, because discount rates are higher. I should get higher returns. Now, do you get it every second, every day, every month, quarter, year? No, you do not. You get it more often than you don't. And that's why we do it, and are always exposed to those securities. So that's why I showed those longer term numbers over, even over 1 year, you have a higher expected return. 3 years, 5 years, 10 years, the odds are always in your favor. That's the expected return. It's not the realized return. Unexpected returns happen as well. That's the time when you don't do so well.
Yep. Fantastic, guys. I think we have to wrap up, but there's a perennial question that has come up right at the top with the most number of thumbs up. And do you want me to answer it, or do one of you want to answer it? When will Dimensional be available in CPF?
Well, look, I would have loved us to be available right now. We are working really, really hard to get our funds available in CPF. It's been a long project for us. There are many hoops for us to jump through as an international manager and with the structure of our UCITS. But we are very hopeful we will be available in Singapore at some point in the not too distant future. I cannot give you a date because I can't do that, but we're working very, very hard at it. And Joel, I'm not sure, Mr. Kim, if you have anything else you'd like to say.
Nope. Same thing. We're working super hard on it, actually, Sam. So hopefully we'll bring this to a close shortly. It's been a long slog, but yeah, I'm very optimistic that we can bring this to a good end.
We are closer than ever to launching Dimensional and CPF, and we hope to be bearer of good news very soon, although we cannot maybe time it exactly.
Like
some of these things are outside the control of Dimensional, right? So, but Dimensional is very much available for your cash savings and your SRS savings, and the factor portfolios from Endowus designed by Endowus and using Dimensional funds only is available right now for those savings. And we hope that we will be able to launch the factor portfolios by Dimensional in CPF as well in the not too distant future. So look out for that. And if you have any questions, follow-up questions, or anything that maybe wasn't very clear, please reach out to support@endowus.com below. And our client advisors, licensed by MAS, will be very, very happy to respond and follow up with any questions. And if there is anything that we need to, get answers from Dimensional themselves, then we can also relay that as well. So with that, I want to thank both Joels. Maybe you guys can both say goodbye, because when you speak, you pop up in the screen. So we'd love to see your faces and say goodbye for the night, and I'll wrap up.
Yeah, again, Sam, thanks for the opportunity. And we obviously value, if I can call it partnership, we're obviously collaborating on this opportunity. So yeah, again, and to the audience, have a great evening. And definitely, if there's anything else that you want to know more about, contact either Endowus or, I think it will have to go through you. More than happy to answer any follow-up questions.
Thank you, Sam. Thank you, Endowus team. Keep up the great work, and we're very happy to be serving Singaporean investors.
Fantastic. Thank you so much. We're very proud to be partnered with Dimensional, especially for this new factor portfolios. And please go to our insights page with the detailed launch article and the deep dive article, which provides a lot more detail. And please also visit the Dimensional website. They have a wealth of research and documents and product insights as well. So it's always useful, and we learn a lot from that as well. So thank you so much, everybody, for joining us tonight. Have a wonderful evening, and see you again very soon.